Hello, everybody. This is topic 3 from chapter 3, cost behavior. I'm Harjinder. The learning objectives in this chapter include um, second look at the behavior of fixed costs and variable costs. We looked at this concept in chapter 2. We will be revisiting it and try to get a better, deeper understanding of how variable costs act and how fixed costs act. Next up, we learn how to analyze mixed costs into variable and fixed components. A mixed cost is a cost that shares characteristics of both a fixed cost and a variable cost. So we are able to break down the mixed cost into its fixed component and variable component. And that's what we learn how to do in this topic. And then finally, to prepare a contribution format income statement. Here, the income statement is cast in a different way from how we've learned to prepare income statements. And this way of presentation helps us do certain types of analysis, which is important for chapter 4, cost volume profit analysis. So we'll be taking a look at that format. Getting started, cost behavior patterns. Depending on how costs respond to changes in production volume, costs may belong to 3 categories: variable costs, fixed costs, and mixed costs. In chapter 2, we learned that variable costs are constant at a per unit level, but they tend to vary with changes in production level. So if you look at this graph, the total variable cost goes up as the activity level goes up. So in this graph here, you notice on the x-axis or the horizontal axis, as the number of customers served increases, the total cost of refreshments, which is the item shown on the vertical axis, goes up as well. And you notice that there is a linear relationship. It goes up in a straight line. And that straight line, the slope of that straight line is the variable cost per customer. Now, it is important to keep in mind that the per unit cost of the refreshments stays constant. All right, so the cost per customer stayed at $10 a unit, or $10 per customer. But of course, as the number of customers went up, the total cost of refreshments went up. Some examples of variable costs that you'll come across in this course. For a merchandising company, the example will be cost of goods sold, the cost of the merchandise sold. For a manufacturing company, the direct costs for manufacturing, including direct materials and direct labor, are variable. And then there tends to be a variable portion of the manufacturing overhead. For example, the indirect materials used, such as lubricants, supplies, power consumption will tend to vary with the number of hours equipment is used. So those could be some examples that would apply in the context of a manufacturing company. For both a merchandising company and a manufacturing company, they can have certain operating costs that are variable. And those operating costs tend to be part of the selling and marketing costs, including commissions paid to salespeople, the cost of shipping goods to customers, and some example of an administrative cost that varies is the clerical costs, such as the cost of preparing invoices. Takes a certain length of time to prepare an invoice. So the more invoices are prepared, the more clerical costs are incurred. Now, I do want to caution you that in most places, the clerks are paid a salary. So there may be a certain element of fallacy here if I pretended that all clerical costs are variable. So this could be something to revisit at a later point in time. For service organizations, i.e. organizations that don't actually sell goods but provide services, some examples of variable costs would include the cost of supplies consumed in providing the services, travel costs, and clerical costs. Fixed costs, in comparison, are constant in a total dollar level, but on a per unit level, they vary inversely with changes in activity level. So what does that mean? If you notice here, it's an example of the cost of leasing a van. If the company's leased a van to serve customers, the lease cost of the van remains constant, regardless of how many customers are served. However, if we were to calculate the per unit cost of the van lease, as the number of customers goes up, the average cost per unit for the van lease falls. We saw this in terms of the factory rent example or depreciation example in chapter 2 when we were looking at the behavior of average cost per unit. The average cost per unit falls as the production volume goes up. So fixed costs are also called capacity costs, and they may be either committed costs or discretionary. Discretionary are costs that are within the management's ability to change. Examples of committed costs include depreciation, rent, salaries, and these are essentially fixed costs that are very difficult to adjust to changes in production levels because they relate to an investment in facilities and equipment and the overall basic structure of the organization. So these costs are difficult to change. Whereas discretionary fixed costs, they actually arise from annual decisions, and it may be possible to hold back on them in short periods of time. And the examples of such discretionary fixed costs include advertising. So for example, if there was a sudden fall in activity level, all of a sudden we went through the lockdown uh, in the month of March for Corona, there could have been a whole bunch of committed advertising time that companies may have pulled back on because it would not help get customers to leave their houses to come to the places, to come to the business. So companies would have been able to adjust their advertising dollars. And likewise, research and development dollars may have been increased. The costs for research and development may have been increased at pharmaceutical companies that were in a position to perhaps start work on identifying some kind of a vaccine or cure for the virus. So these cost dollars can be adjusted either upwards or downwards in the short run. Let's take a look at an example. This is exercise 3-1. Here, the company Goes Down Smooth is an operator of smoothie bars. Its fixed weekly expense for a smoothie bar is $2,500. And we are told that the variable cost per smoothie served is 75 cents. And there's a whole bunch of question marks or blanks that we need to fill in. So given that 2,100 smoothies were served in a week, and in another week, 2,800 smoothies are served, and in yet another week, 3,500 smoothies are served. Well, what would the fixed cost be? Well, fixed cost in total does not change. It remains constant regardless of changes in activity level. So at 2,100 units, the fixed cost of running the smoothie bar should stay $2,500. However, the variable cost, 75 cents for one smoothie, for 2,100 smoothies, it'll be 2,100 multiplied by 75 cents, or $1,575. We add the $2,500 of fixed costs to the 1,575 of variable costs, we get total costs $4,075. The cost per smoothie served, to calculate that, you want to divide the total cost, $4,075, by the 2,100 smoothies served, and you get about $1.94 per smoothie served. In the following week, if 2,800 smoothies were served, fixed cost should not change. It should stay $2,500. However, at 75 cents per smoothie, 2,800 smoothies will cost us $2,100 to make, giving us a total cost of $4,600. This $4,600 of total cost, when divided by 2,800 smoothies, works out to an average cost per smoothie served of $1.64. We can also do the math at a 3,500 smoothie level. Fixed cost remains constant, $2,500. The variable cost now becomes 3,500 smoothies multiplied by 75 cents, or $2,625, giving us a total cost of $5,125. The average cost per smoothie served, as you could guess, falls even further to $1.46. Now, if you ask yourself, why is this happening? The variable cost per smoothie served isn't changing. It stays at 75 cents. What's happening is that the fixed cost of $2,500 is getting spread over a larger number of smoothies served. So as the number of smoothies served goes up, the average fixed cost per smoothie served falls. And the consequence is that the total cost per smoothie served falls as well. And this is the concept that in microeconomics is called economies of scale. As a business grows bigger, for a certain length of time, it experiences a decline in average cost per unit. The second part of the question asked, does the cost per smoothie increase, decrease, or remain the same as the number of smoothies served in a week increases? And we notice that it actually decreases. Rationale for that is what I explained a while ago. This is the result of the fixed cost of running a smoothie bar being spread over a larger number of smoothies served. Next up, we'll take a look at mixed costs. And mixed costs have characteristics that are shared with both variable costs and fixed costs. So what happens here is that the mixed costs in total dollars vary directly with changes in the activity level. So as production volume increases, the total mixed cost actually goes up. However, curiously, the average cost per unit varies inversely with the changes in production level. So when you look at the average cost per unit for a mixed cost, the average cost per unit falls as more production volume is generated. So in a graph, on a graph, it takes this kind of a shape. At zero production level, so this example here is total vehicle costs and in response to the number of kilometers driven, you would notice that even when the vehicle is not driven at all, there is a certain cost. There's $400 of vehicle costs. And that may be, you know, if you from your own life space, you would notice that would be possibly the, if the vehicle is say leased, your lease cost plus the cost of insuring the car. So even if you don't drive your car and it remains parked, you still are responsible to pay the lease cost and you still are responsible to pay for insurance. So that would be a cost that is fixed. And then depending on how many kilometers you drive, there will be the cost of fuel. Um, there could be maintenance costs as well, which are sort of driven by how much the vehicle is driven. So those costs will be the variable cost portion. So the mixed cost essentially has a fixed cost portion, fixed cost element, and a variable cost element. We assume that the variable costs will represent a straight line, and that assumption is not wholly unreasonable. They may not exactly fall in a straight line, but they tend to fall near the straight line curve path, such that we are able to use that relationship to estimate that the variable cost per unit of activity is actually the slope of that line. And slope, if you remember from grade school, is essentially rise over run, right? So that is the approach we take when we apply the high-low formula that we are going to look at in a couple of slides. So mixed costs, as we saw, contain elements of both variable and fixed costs. In the world of economics, these costs are called semi-variable. And as such, a mixed cost can be denoted as a straight line. So equation of a straight line is y equals a plus bx, where y is essentially the vertical axis, which represents the mixed cost. X represents the horizontal axis, which is the independent variable. And A is the intercept, which for our purposes represents the total fixed cost. And B is the slope. To analyze mixed costs, we can use a variety of approaches. First up, we could use account analysis, where the accounting team would try to classify each account as either variable or fixed based on their knowledge about how the item acts or how the item behaves. We could use an engineering approach, which involves a detailed analysis of cost behavior based on an industrial engineer's evaluation of the inputs needed to carry out a particular activity and the costs of those inputs. And thirdly, we could use diagnostics, whereby we use techniques to split mixed costs into their variable and fixed cost portions, making an assumption that there is a linear relationship between the mixed cost and some independent variable. Here's an example of the use of the analytical approach, the account analysis approach. So this company here, Anand Limited, is a maker of industrial use drones. And the account analysis shows that a few items are mixed costs. They have product supervision costs that are 80% fixed, utilities costs that are 20% fixed, sales staff wages that are 70% fixed, and quality control inspection costs that are 90% fixed. And we're also given the total costs in dollars for the year 2016 for each of these cost items. And in addition, we are told that in 2016, the company produced and sold 500 drones. So when you're given information like this, you would first want to split up the total costs that are given into a fixed cost portion and a variable cost portion. So since we know that the product supervision costs are 80% fixed, And in 2016, the total cost was $150,000. We can calculate 80% of $150,000 to get $120,000 as being the fixed costs in the year 2016. If the total costs were 150,000, then the remainder 30,000 was variable. And since the business produced 500 drones in total, $30,000 divided by 500 drones gives us a variable cost portion, variable cost per unit of $60. In a similar manner, we can break down the utilities costs. The total utilities cost in 2016 was 60,000, of which we're told 20% was fixed. 20% of 60,000 is $12,000. So the remainder, 48,000, would have been variable. And given that 500 drones were produced, 48,000 divided by 500 gives us $96 as being the variable cost per unit for the utilities. For sales staff wages, total cost in 2016 was 200,000, of which 70% was fixed. And we are told that the 30% variable portion relates to sales commissions based on total sales. So we have to be mindful whether the number of units produced is what the cost varies with, or is it the number of units sold that the cost varies with. Here it doesn't matter because the company produced and sold 500 drones. If, on the other hand, we were told that the company produced 500 and they sold 400, then for calculating the variable portion of the sales staff wages, we will have used the number of drones sold, because the variable portion, we're told, relates to the sales commissions based on total sales. All right, so 70% fixed out of 200,000 gives us $140,000 of fixed costs. Remainder 60,000 is variable. Divide the 60,000 by 500 units, we get $120. Finally, for the quality control inspections, 90% of the total cost was fixed, and the 2016 total cost was 40,000. We get $36,000 as the total fixed cost portion, and 4,000 was variable. And we're told that half of the manufactured units are inspected each year. So if we produce 200 and 500 drones, half of the 500, 250 drones will have been inspected. But really, that is more of a red herring for us, because we can simply calculate the variable cost per unit on the based on the number of units produced, and that'll be easier for us to work with. We take the $4,000 of the variable cost and divide by 500 to get $8, but this is $8 for each unit produced. If in an exam you were asked what is the variable quality control cost for each unit inspected, you will need to then adjust. You will then need to have taken half of 500 drones. So half of 500 drones is 250 drones, and then divided the $4,000 of the variable cost by 250 drones. In that case, your variable cost per unit inspected will be $8 times 2, $16. Okay, for our purposes, we're happy calculating $8 per unit produced, because whatever is the number of units produced, half of them get inspected. So that relationship is not going to change. So after having done this preliminary analysis, we then go look up what the requirement is. So the first part of the question asks us that management expects to sell 700 drones compared to 500 in 2016. In the year 2017, does not expect any cost changes, and plans to maintain the sales price of $2,000 per drone. It's asking us to estimate the total cost for each of the mixed cost items that we calculated in the earlier slide. So with 700 units produced and sold, the product supervision, we had calculated a fixed cost portion of $120,000, and we had calculated a variable cost per unit produced of $60. So if 700 units are to be produced, 700 units multiplied by $60 for each unit produced will work out to a variable cost of $42,000. 120,000 fixed, 42,000 variable, added together gives us total product supervision costs of $162,000. Likewise, for utilities, we had calculated the fixed portion of utilities to be $12,000 and a variable cost per unit produced of $96. When 700 units are to be produced, 700 multiplied by $96 per unit works out to $67,200 as the variable portion of the utilities cost. Total utilities cost, therefore, works out to $79,200. For the sales staff wages, the variable portion depends on the number of units sold. However, in this simple problem, the number of units produced and sold are identical. We had calculated a fixed portion, that'd be the salaries, I guess, $140,000. And then for every drone sold, we pay our salespeople a commission of $120. 700 units are to be sold. We anticipate a total sales commission of $84,000. 700 multiplied by $120. Total sales staff wages, therefore, works out to $224,000. And finally, quality control. The fixed cost of quality control was $36,000, and we had calculated a variable cost of $8 per unit produced. I explained that in the earlier slide because that would be easier for us to do the math with. If 700 units are to be produced, we will spend $8 times 700 units, $5,600 towards the variable quality control costs. The total works out to $41,600. Now, some of you may sort of still go, oh, Hardinder, didn't they say that half the units produced are actually inspected? True, but in that case, you have to use the $16 per unit inspected. So you would calculate half of 700 units, 350 units will be inspected, but the cost of inspection for each unit will then be $16. So 350 units produced, 350 units inspected times $16 of inspection cost per unit will still work out to $5,600. Either way, you arrive at the same answer. Right, so that was an example of using account analysis. Let's take a look at diagnostics. There are three approaches to diagnostics. First one is to use scattergram plots. The second one is high-low method, and the third is least squares regression. So with the scattergram plots, essentially what we do is we plot the dependent variable, which is the mixed cost, the dollars, on the y-axis, and the independent variable, so could be, say, direct labor hours, on the x-axis. And we use the plots and try to approximate a line of best fit through those scatter plots, extended to the y-axis to estimate the intercept, which is the fixed cost portion, and the slope, which is the variable cost per unit. And it actually helps us identify if there is a linear relationship between the mixed cost and the independent variable. When we look at the scattergram, we should be able to detect some kind of a a linear relationship that as the number of the independent variable units increase, the mixed cost also should be increasing if it's a direct relationship. The high-low method, here we actually identify the high and the low activity levels. So the x-axis numbers, we identify a high number and a low activity level number, and the associated total mixed costs at those activity levels. Then we calculate the difference between the activity levels and the costs. The change that we calculate in part 2, it represents the increase in cost due to a change in the activity level, which is for us the independent variable. We can use the change amounts to calculate the slope and then use it to calculate the fixed cost portion, the intercept. The fixed cost portion is calculated by subtracting the total variable cost portion from the total mixed costs. The variable cost is calculated by dividing the change in cost by the change in activity level. Here is an example, exercise 3-8. We're given information on the number of blood tests performed and the related costs over the last 9 months at the Brentline Hospital. We're given numbers for the month of January all the way through September. We're given the number of blood tests that were done in each month and the total blood test costs incurred in each month. So it is important that we keep in mind that for our purposes, the number of blood tests would be the driver of the blood test cost, right? So we need to use the high-low method to estimate the cost formula for blood tests. So express the cost of a blood test in the form of y equals a plus bx. So our x for our purposes is the number of blood tests performed, and the blood test costs are the y. An easy way to remember is because costs are expressed in terms of money, money has the letter Y at the end, right? So money, remember, and then Y. So the dollars here should be the Y variable, and therefore the other variable turns out to be the X variable. Now what we're supposed to do if you are using high-low method is identify from the X column a high point and a low point. If you notice, and it shouldn't take more than a cursory glance, the maximum number of blood tests were performed in the month of February, and the least number of blood tests were done in the month of June. So February represents the high month, and June represents the low month. You got to remember to always pick up your high and low rows from the X column, okay? Because you could notice that whereas the month of February is also the month where the cost of blood tests was the maximum, the lowest cost though was experienced in the month of July, $8,400 versus $8,500 in June. But $8,400 of costs were incurred for 1,550 tests. Okay, so we don't want, so this is the caution that I must remind you of. We don't want to be picking the high and the low points from both columns. We just want to pick up the high row and the low row from the X column, the independent variable column, and then simply pick up the related dollar amounts. Okay, so we're able to construct a table like this. The high month was February, in which 3,500 blood tests were performed at a total cost of $14,500. The low month was June, in which 1,500 blood tests were done at a cost of $8,500. Once we've gotten these numbers, we can calculate the difference. So the high minus the low gives us the change, the difference of 2,000 blood tests and $6,000 in costs. So a way to read this is at everything being equal, the difference in the costs in the months of February and June, $6,000, was due to the difference in the number of blood tests performed in the 2 months. That's 2,000. So 2,000 blood tests resulted, so 2,000 additional blood tests rather, resulted in an additional cost of $6,000. And we can use this information to calculate the variable cost for each blood test, which is the slope or the B for our cost formula. So each blood test variable cost works out to $3 on average. Now, once we've calculated the variable cost number, we can then go back and calculate the fixed cost portion by using this value of $3 for B in either of the high month or the low month. So I went ahead and did it for the month of June. So total blood test costs in June. Recall we did 1,500 blood tests. If each blood test has a variable cost of $3, then 1,500 blood tests should have cost us 1,500 times 3, $4,500. But the total cost was $8,500. That can only be explained by the fact that there is a fixed cost component. So the fixed cost, the A, the intercept value, plus the variable cost of the blood test for the month of June is equal to 8,500. And then it's just a matter of calculating the value of A. The value of A is $4,000. There's a $4,000 fixed cost each month. Now you could have alternatively done the work for February, and you could have said, hey, in February, 3,500 tests were done. If each test on average costs $3, 3,500 tests should have cost 3,500 times $3 or $10,500. But the total cost in the month of February was 14,500. Out of the 14,500, the variable cost portion is 10,500. The difference, 4,000, must be the fixed cost per month. Okay, so you would have gotten the answer regardless of whether you chose the high row or the low row to calculate the fixed cost component. Once you've calculated this, then you can set up the cost formula for the blood tests. In every month, the total blood test costs worked out to $4,000, which is the fixed cost portion, plus $3, which is the average cost of each test, times X, where X is the number of blood tests performed in the month. The second part of the question said, using the cost formula we derived above, what blood test costs will you expect to be incurred in a month in which 2,300 blood tests are done? Well, essentially what we have been told is if X is equal to 2,300, what is Y? Well, Y equals 4,000, the fixed cost portion, plus 3 times X. If X is 2,300, then Y will be 4,000 plus 3 times 2,300, or $10,900. The third approach for diagnostics is least squares regression. For least square regression, if we were having face-to-face classes, I would have gone over the calculation using a BA2 plus calculator, which is the recommended calculator for the course. In the absence of our ability to have the in-class interface, there is a YouTube video that you could watch to learn how to do least squares regression calculation. It is also possible to do the calculation by hand. I don't recommend it because it is very unlikely that anybody today is actually setting up tables to do the calculation of least square regression. It's just way too time consuming. Nobody does it. But should you have an interest in learning how to do that, you can watch another YouTube video. The easiest approach now, given that we are having classes that are remote and you will be working on your exams using Excel, the easiest approach is to use the functions in Excel to calculate the slope, the variable cost per unit. The Excel function is called the linest, L-I-N-E-S-T. And to calculate the fixed costs for the period, we use the intercept function. Okay? So I will show you how to do that math for the same example, the Brentline Hospital example that we looked at using Excel. Okay, and while I show you that, I'll also show you the scattergram approach. This will be a separate video that I will hopefully be able to splice in at this point in time. Here we are looking at the information from the exercise for Brentline Hospital. And you would notice here we have the information provided for the months of January to September for the number of blood tests performed and the blood test costs. Now, in order for me to do work with the numbers, it is important that I have them in Excel form. So what I've gone ahead and done is copied the information in these Excel cells. Okay, so whatever was the information from the problem, I've reproduced the information in Excel cells. Got the blood tests done each month and the costs of blood tests in each month. So I'm going to use this opportunity to show you how to work with the scattergrams. So if you're looking to work with scattergrams, what we do is we want to select this data and using Excel, we want to insert, click insert, and we want to insert a chart, and we want to go with a scatter plot. So the first chart is the scatter plot. So this chart, and if I could just move the chart a little bit to the right, you would notice has got the number of blood tests in the horizontal axis and the total blood test costs in the vertical axis. So here you would notice are the dots. The dots represent the blood test costs relative to the number of blood tests. Okay, so that, if you notice, it's not really a complete straight line. However, if you cut yourself a little bit of slack though, you notice that there does seem to be some kind of a direct relationship between the number of blood tests and the total blood test cost, to the point that we can make an assumption that the relationship is linear. So if we do that, then what we can try to do is try to pass through a line that best fits the data, right? And so I'm trying here to pass this line through the outermost and the lowest. And if I were to extend this straight line, you notice that it actually intersects at 4,000. So when we did the high-low method calculation, we had calculated the intercept to be $4,000. The fixed cost per month had worked out to $4,000. And if you notice, that's exactly what I've done. I have tried to force the line through the cost dollars that correspond to the maximum number of blood tests performed and the lowest number of blood tests performed. So how do I know it is the lowest number? I picked up the dot that was leftmost, right? The dot that was leftmost and the dot that was rightmost. And I just passed a line through them and extended it through the y-axis. Where the line cuts the y-axis is the intercept or the fixed cost. And if I were to calculate the slope of this line, of course, the slope of this line will be, so I think it was 14,500, take away the 4,000, that'll give me 10,500 rise, and the run is 3,500. So 10,500 divided by 3,500 works out to $3 for each test. But I'm sure you would be kind of murmuring to yourself, man, that just seems like a lot of work and it's possibly also imprecise. What if you make mistakes and so on? And that's exactly the point. So if you are going to be using just 2 data points for your work, then you might as well use high, low, and be done. What's better is to try to fit a least square regression line. And the least square regression line attempts to plot a line that will be the best fit given these data points. Now, I don't want to get into too much of details about least square regressions because you probably don't have a whole lot of interest in learning about statistical approaches. But from a practical point of view, how do we do the math? Well, to use Excel, the function to calculate the fixed cost portion is called intercept, and the function to calculate the variable cost is linest. And you don't have to do them in any particular order. You can do either one first. So if I was to do the intercept calculation first, so I typically input a function by pressing plus. Alternatively, you could actually press equal. The equal sign is actually more commonly used. So equal, and then you start typing enter, and notice that Excel actually starts giving you some choices. So I can see the function here, intercept, right here. So I can click on that. And so Excel does the rest. It types in the rest of the function. And now it is prompting me to provide it with the data. And it's saying, tell me what the y's are, what are the known y's, and what are the known x's. So my known y's are the blood test costs. So what do? I click on the first cell and then just go down. So I select all of them. So these are N6 through N14. And then I put a comma, and then I do the same thing for the known known x's, M6 through M14. And then I close the bracket and press enter. Excel spits out $3,509. Now, you would be wondering, Harjinder, we had found $4,000 as the fixed cost under high-low. How come this is different? The reason why this is different is that in high-low, we were only using 2 data points, the high point and the low point, whereas with least squares, we try to use as many. So we're trying to fit the line through as many of the data points as possible. And so, of course, least squares is technically a lot more accurate, and the estimates will be different under least squares than the high-low estimates. For the slope, which is the variable cost portion, the function is linest. So again, if I start typing in LIN, Excel gives me the rest of the function. And similar to the fixed cost, it asks me for known Ys, known X's, and it's got constant stats. We don't really need to worry about these rests. We just need to put in the known Ys and comma, the known X's, and close. Press enter. Now, if you press enter, initially it might show up as 3.22. So what I had done was I actually increased the number of decimals, right? So you can increase or decrease the number of decimals. Of course, if you're looking to be more precise, the more decimal points you go to, the more precise your answer is. So since our calculations, since our numbers are all in 5 places of decimal, ideally you want to go all the way to 5 places for, if you have 5-digit numbers, you should go up to 5 places of decimal to get the more accurate answer. But never mind, really what Excel is doing is it's showing me the number of decimal places I want to see, but in reality, Excel is storing the value all the way to the 15th place of decimal. So it's very, very, very accurate. So my cost formula then, Y equals the intercept, which is the fixed cost portion, 3,509, plus the variable cost portion, 3.2164x. And if I had to calculate the estimated cost for 2,300 tests, I want to use Excel to do the math. I would say, okay, so Y equals 3,509, so that's N16. I click on that cell, plus this is the variable cost, 3.2164, whatever is stored there, times, so for multiplication in Excel, you got to use the asterisk symbol, and X is 2,300. So I type in 2,300 and I press enter. I get $10,906. So if I actually go and try to make this a little bit good to look at, oops, all of a sudden it becomes a bunch of hashtags. And that's just Excel telling me I don't have enough room to show all the numbers. So it's fine. I can just decrease the decimals. So 10,906.2. Well, that's really too small. So, I can just go down to the nearest dollar and be happy with it. $10,906 is the nearest dollar. Brentline Hospital example that we looked at using Excel. Okay, and while I show you that, I'll also show you the scattergram approach. This will be a separate video that I will hopefully be able to splice in at this point in time. So using Excel and the least squares regression method, if we were to estimate the cost formula for the blood tests, we will have gotten a result of fixed cost per month, the intercept, is $3,509. The variable cost per test is $3 and a bunch of decimal points, so 3.2164. And the total cost formula there ends up being Y equals 3,509 plus 3.2164x, where x is the number of blood tests performed in a given month. Using this cost formula, if we were to anticipate what the total blood test cost will be in a month where 2,300 tests are performed, we will plot 2,300. We will use 2,300 as the value for X. And our total cost estimate, therefore, works out to $10,906. You recall, using high-low, we had estimated the total cost to be $10,900. 10,900, 10,906. The difference is a very small number, $6 for a 5-digit value. I believe the high-low method did reasonably well. And typically, the high-low method will do typically well when you have few observations, when you have few data points. So 9 months worth of data is not a whole lot of data. Using least square regressions makes more sense when you have more data. So you should have at least 20 months or years worth of data in order to really get the most out of least square regressions. Otherwise, using high-low is pretty fine. Next, let's take a look at the contribution format income statement. It is an income statement in which costs are separated into variable costs and fixed cost categories. And the difference between sales revenue and total variable costs is called contribution margin. And when we set up the contribution format income statement, we prepare 3 columns, one for total dollars, one for the cost per unit, the dollars per unit, and then express those lines as a percentage of sales. Something along this, the line of this table that you see. Here you would notice 400 speakers were sold in a given period. Sales dollars in total are $100,000. For 400 speakers, you can divide $100,000 by the 400 speakers to get per unit selling price $250. Variable expenses added up to $60,000. So 400 speakers, 60,000 works out to $150 for each unit. Sales minus the total variable expenses is contribution margin. And then if you take away fixed costs from contribution margin, you get operating income. The per unit calculation and the percentage of sales calculation is only done for up to the contribution margin line. I have an example for you folks. So Alice Jones is the financial analyst at NorthJet Air Charters. She's examining the behavior of operating costs for budgeting purposes. The operating costs consist of 3 types of costs. They are variable costs, such as jet fuel costs, $14 per kilometer of fuel flown. Fixed operating costs, such as aircrew salaries of $110,000 a month, and mixed operating costs, such as aircraft maintenance. Alice has obtained the following costs for the past 6 months, January through June, and we are given information on the number of kilometers flown and the operating costs. And we are asked to estimate a cost formula for mixed maintenance, the operating costs, essentially the mixed operating costs, using high-low. So we just looked at the high-low method a few slides earlier. The first thing we do is identify the high and the low points in amongst the independent variable. So keep in mind, operating costs are where the dollars are. And remember, money ends in Y. So Y is the dollars. It's 360,000 for January and so on. And so the number of kilometers flown is our X column. And we noticed that January is the month where we had the least number of kilometers flown. And May is the month where we had the most number of kilometers flown. So using that information, we can see that in the month of May, when 19,000 kilometers were flown, the operating costs were 576,000. And in the month of January, when 10,000 kilometers were flown, the total operating costs were $360,000. You can calculate the difference between the two, and we get for 9,000 kilometers, the difference in operating costs works out to $216,000. So that's in a way saying that the extra 9,000 kilometers flown resulted in extra operating costs of $216,000. So if we divide the $216,000 by the 9,000 kilometers, we get the variable cost per kilometer flown to be $24. Use this information and plot it back into either row. I think January will be easier for us because it's a nice round 10,000 kilometers. So in the month of January, if each kilometer flown has a variable cost portion of $24 for 10,000 kilometers, 24 times 10,000 works out to $240,000 of total variable costs. The total operating costs in the month of January were $360,000. Of the $360,000, if the variable portion is $240,000, then the difference must be the fixed cost component. So that helps us figure out the fixed cost portion of $120,000. Now, this, mind you, is total fixed cost per month, right? 120,000 is the total fixed cost per month. And $24 per kilometer is the total variable cost, which includes the cost of jet fuel. The $120,000 fixed cost includes the aircrew salaries of $110,000. So we were asked to estimate a cost formula for the maintenance cost, which was the mixed cost. So these are not certainly our components of the cost formula for mixed maintenance. We need to take out from the fixed costs number the fixed portion of the aircrew salaries. And similarly, from the variable cost per kilometer, we need to deduct the jet fuel costs per kilometer. That then gives us the portions for maintenance. So maintenance actually has a fixed cost per month of $10,000 and a variable cost per kilometer of $10. Therefore, the cost formula for maintenance is Y equals 10,000 plus 10x, where x is the number of kilometers flown. Continuing with the example, the second part asks us to prepare a contribution format income statement for the month of July, where the company expects to fly 17,000 kilometers. And we are told that the company charges $50 for each kilometer flown. So this would be a projected income statement because the month of July has still not passed. And we are making it in the contribution format. So we will have 3 columns, a column for total dollars, a column for dollars per unit, and a column for percentage of sales. So 17,000 kilometers at $50 per kilometer flown works out to sales revenue, $850,000. The per unit price is $50. And as a percentage of sales, of course, that will be 100%. Next up, we want to look at the variable costs. So variable costs, there's 2. We have the jet fuel cost, which costs us $14 for each kilometer. $14 for each kilometer flown for 17,000 kilometers works out to $238,000 in total. Now, if you were to calculate it as a percentage of sales, probably easiest to do divide $14 by the $50 per kilometer. 14 divided by 50 gives you 28%. You could also have divided the $238,000 total dollars by the sales of $850,000. You will have gotten 28% as the percentage of sales. Now that jet fuel cost is not the only variable cost. There is the variable cost portion of maintenance, which we had calculated in the earlier slide to be $10 for each kilometer. So 17,000 kilometers flown would work out to $170,000 of maintenance cost. As a percentage of sales, 10 divided by 50, 20%. So total variable costs, therefore, are $24 a unit, or $408,000 in total for 17,000 kilometers flown. And as a percentage of sales, that's 48%. Sales minus the total variable cost gives us contribution margin. Contribution margin is the difference between sales and total variable costs. So on a per unit basis, 50 minus 24, we get contribution margin of $26 per kilometer. As a percentage of sales, that's 52%. The total dollars are $442,000. Next, you look at the fixed costs. And fixed costs, again, we've got two portions. We have the aircrew salaries, $110,000, and the fixed portion of maintenance, which is $10,000. Added up, we get total fixed costs, $120,000. Subtract these total fixed costs from contribution margin. So $442,000 of contribution margin minus $120,000 of fixed costs, we're left with operating income, $322,000. You should keep in mind that the per unit and the percentage of sales information is not shown for fixed costs. We only do the math up to the contribution margin row. Okay, so on that note, this concludes the lecture video for chapter 3. We will be doing exercises and problems in class, and I look forward to doing that with you folks. For now, this is it.